For decades, wealthy families have been quietly passing $1 million or more to the next generation, completely tax-free. They do it using a handful of straightforward legal strategies that anyone can use, but almost nobody knows about. Today, I am going to show you exactly how it is done, in plain language. And strategy number 4 is the sleeper. It requires almost no paperwork and works for households at every income level. These are not loopholes or gray areas. They are black and white rules of the IRS. Used together, they can move fortunes with 0 income tax, 0 gift tax, and 0 estate tax. That is how family wealth quietly compounds across generations. Stay with me, because we will break down 7 strategies and the exact order to use them. Quick favor before we dive in. Subscribe now, because new wealth-building breakdowns publish every single day, and you do not want to miss what comes next. Strategy 1. The annual gift tax exclusion. In 2026, you can give up to $19,000 per recipient with no gift tax, no return, and no hit to your lifetime exemption. It is per donor and per recipient, and there is no limit on how many people you can gift to. Married couples can use gift splitting to effectively double the amount. That means $38,000 per person, per year, tax-free. With 8 recipients, a couple can move $304,000 out of their estate in a single year. Repeat it every year and the effect compounds. Over 2 decades, that steady drip becomes millions shifted to the next generation. Tax-free. The only real requirement is present interest. The recipient must have immediate, unrestricted access to the gift. Gifts under the annual limit require no gift tax return, no income reporting by the recipient, and no reduction of your lifetime exemption. It is the first step every family should master. Strategy 2. Pay medical and education expenses directly. When you pay a qualifying tuition bill or a medical bill directly to the provider, the amount is excluded entirely from gift tax rules. There is no dollar cap, and it does not use your annual exclusion or your lifetime exemption. The key is mechanics. Pay the institution directly. Paying the family member first reclassifies the transfer as a standard gift. You can stack this with the annual exclusion in the same year for the same person. Cover large tuition or medical costs directly and still give $19,000 or $38,000 as an annual gift, all without filing a gift tax return. It provides immediate relief to loved ones and moves significant assets out of your taxable estate with surgical precision. Simple rule, outsized impact. Strategy 3. The lifetime gift and estate tax exemption. In 2026, each person can transfer up to $15 million during life or at death, free of federal transfer tax. For married couples, the effective shield is about $30 million through exemption stacking and portability. A looming sunset once threatened to cut the exemption roughly in half. New law made the higher exemption permanent and indexed to inflation. Permanent does not mean untouchable, but it does reduce uncertainty for planning. Using the exemption during life moves appreciating assets outside your estate, so all future growth escapes the estate tax. Gift $10 million of growth assets. If they double, that extra $10 million grows outside your estate. Trust can add control, creditor protection, and long-term governance for family wealth. Anything you use during life reduces what shelters your estate at death, so coordinate carefully. It is especially powerful for closely held businesses and real estate, assets likely to appreciate. Plan early so the compounding happens outside your estate for as long as possible. The goal is to shift growth, secure control, and minimize future estate taxes. Now for the strategy that feels like a cheat code when done right. Before we open the box on Strategy 4, subscribe so you do not miss it. Here is the payoff I promised. Strategy 4. The Roth IRA Inheritance Strategy. You fund a Roth IRA with after-tax dollars. Inside, dividends, interest, and gains compound without tax. You are never forced to take required minimum distributions during your lifetime, maximizing tax-free compounding. Name a proper beneficiary. When you pass, the account transfers by beneficiary form, not by will. Rule 1. The 5-year rule. If the Roth is at least 5 years old, beneficiaries can withdraw earnings tax-free. Rule 2. The 10-year rule. Most non-spouse beneficiaries must empty the account by the end of year 10. They can withdraw all at once or in installments over the decade, still generally tax-free. A surviving spouse can treat the inherited Roth as their own, with no required withdrawals and continued tax-free growth. Then they can name the next generation, extending the tax-free legacy across lifetimes. Open it, fund it, invest prudently, and keep the beneficiary designations current. No trust drafting required to unlock the core benefits. A well-funded Roth can pass $1 million or more completely income tax-free to heirs. It is the simplest engine of multi-generational tax-free inheritance in the entire code. Strategy 5. The step up in basis on appreciated assets. For assets like real estate, stocks, and art, the cost basis resets to fair market value at the date of death. If a property bought for $50,000 is worth $1,050,000 at death, the heir's new basis is $1,050,000. Selling at that value shortly after inheritance yields zero taxable gain. Likewise, long-held stocks receive a fresh basis, erasing decades of embedded capital gains. Combined with the lifetime exemption, many estates pass free of estate tax, and the step-up eliminates capital gains for heirs. Heirs receive a clean slate, free to hold or sell based on strategy, not tax baggage. It rewards patient, long-term ownership. Strategy 6. The 529 Plan Generational Transfer. Contributions grow tax-deferred and are distributed tax-free for qualified education expenses, often with state tax benefits. You can superfund by contributing 5 years' worth of annual exclusion at once. That is 5 times $19,000 for an individual, or 5 times $38,000 for a married couple, to one beneficiary in a single year. The account owner retains control and can change beneficiaries within the family. If one child does not need the funds, you can shift the beneficiary to a sibling, cousin, or even a future generation. Funds grow outside your taxable estate and are distributed tax-free for education. It functions like a family education endowment without the complexity of a formal trust. Strategy 7. The Irrevocable Life Insurance Trust, sometimes called an ILIT. The trust owns a life insurance policy. When the insured dies, the death benefit is paid to the trust, not to the estate. Because the trust is the owner, the death benefit is excluded from the taxable estate. Large estates often hold illiquid assets. Estate tax is typically due within 9 months, and heirs may be forced to sell assets to pay the bill. An ILIT provides immediate income tax-free liquidity to cover taxes and expenses, preserving core assets. Annual gifts to the trust, often structured with crummy powers, fund the premiums while qualifying for the annual gift exclusion. The trust is irrevocable, so design it carefully. Once established, terms are generally not reversible. For the right family, it is a fortress that keeps the business, farm, or properties intact for the next generation. Here is a clear order of operations. 1. Review and update beneficiary designations on retirement accounts and life insurance. 2. Use the annual gift exclusion every year. 3. Fund 529 plans for education. 4. Build your Roth IRA and keep beneficiaries current. For larger estates, coordinate lifetime exemption gifts into trusts and consider an ILIT to secure liquidity. Avoid the single mistake that ruins these strategies, failing to name proper beneficiaries or naming your estate. At 12 minutes, subscribe and drop a comment with which strategy you will use first, and share this with someone who needs it.